Let's start by looking at the specifics for accounting for the held-to-maturity debt investment classification. Now, this is the easiest. All three methods, you're going to record the interest revenue. You're going to have to amortize any discount or premium on that bond if there was one at issuance. But there's nothing else to do for the held-to-maturity ones. So these are the easiest, and let's start there. The only entries are for the purchase of the bond, the bond investment, the interest received or the interest revenue, and then if there's a sale, it would be also for the sale. No entry to record changes in fair value because changes in fair values are ignored. If the bonds are sold before maturity, if that were to happen, this is what the entry would look like. We're going to debit cash because we're selling an investment. We're going to receive cash. This is for the selling price. We're going to credit investment in bonds because we're getting rid of selling off the investment in bonds, the asset. The bond's face value, principal. We're going to credit interest revenue for any interest that may have accrued between the last interest payment date and the date of the sale. And then we would, of course, remove any discount or premium. And then debit or credit. Debit the difference. If the difference is a debit, we debit the account loss on sale of the debt investment, or if the difference is a credit, we credit the difference to gain on sale of the bond investment. So when we look back at the example that we worked before, example 1, we recorded the entry to purchase the bonds, debit investment in bonds 700,000. We purchased them for 666,634, and we recorded the discount on bond investments, the contra asset. We recorded the following journal entry for the interest. We know what the balance sheet reported for amortized cost. Well, that would be done no matter what type of bond we had, held to maturity, trading, or available for sale. The difference is, this is all we record for held to maturity bonds, nothing else. I mean, we would continue doing this every 6 months. We would have another interest received, cash, interest revenue, another amortization or reduction of that discount account. And we would just do that all the way until the bond matures. This was a 3-year bond, so 6 periods, and then we would collect our principal. So let's just do one more example under the held to maturity category. Example 2, a company issues 900,000 6% 10-year semi-annual bonds on January 1st, 2024, and they get 1,047,163. The market rate is 4%. All right, so the market's offering 4%. These bonds are offering 6%. Do we want more money or do we want less money? We want more money, so we go to everybody flocks to the 6% bonds. That drives the price up above the face value of 900,000. And so in order to purchase, so you purchase the bonds, in order to purchase them, you have to spend 1,047,163. So let's start with that entry for the purchase in example 2. We're going to debit the account investment in bonds. Record this account at the face value, which is 900,000. Skip a line. We give up cash, so we credit cash at the selling price, 1,047,163. And then that difference between the selling price we paid, and the amount we're going to be receiving at maturity is recorded to premium on bond investment or premium on investment in bonds. And this works out to be 147,163. Okay, so time goes on. 6 months later, it's an interest payment date. Entry for interest on that first payment date, which would be June 30th. 24, we're receiving cash. The interest that we receive is based on the terms of that bond investment. Face value 900,000. The stated rate on the bond was 6%. These are semi-annual, so times 6 out of 12, and that's going to work out to be 27,000. The interest revenue that we record is not based on the stated rate, or based on the face value. It's going to be based on the beginning carrying value or amortized cost, the bond investment plus the balance in the premium, which is 147,163. Multiply this by the market rate. The market rate is 4%, and these are semi-annual, so times 1/2 or 6 out of 12. And this works out to be 20,943. The difference between the cash interest and the interest revenue is recorded as a reduction or a credit to the premium on bond investment account. So whereas the discount to a bond investment was a contra asset, a premium is what's known as adds to the value of the asset, is what's known as an adjunct account, adding to the value of an asset account. And this works out to be 6,057. So what is the amortized cost of the bonds on June 30th? We have the investment in bonds account, 900,000. We add the balance in the premium. Premium started off as 147,163. And then in this entry here, we reduce the premium by 6,057. So our balance in the premium is 141,106. And so our amortized cost, or what we would call our carrying value, is 1,041,106. And then time goes by, and we have our next interest receipt. Interest payment date by the borrower, interest receipt date for us. All right, so we receive cash, debit cash, 27,000 again. Those terms on the bond are always the same, 900,000, 6%, semi-annual, times 1/2. Record the interest revenue. Now this will not be the same amount as it was before. It was previously 20,943. And the reason why is this was our beginning carrying value, 104,763. Now we're using this amortized cost, 1,041,106 times the market rate of 4%, semi-annual, so times 6 out of 12, or 1/2. Interest revenue is 20,822. And the difference between the cash we receive and our interest revenue is recorded as a reduction to the premium on bonds payable. Sorry, not bonds payable. Premium on the bond investment. And this works out to be $6,178. What's the amortized cost on 12/31? We have our investment in bonds, $900,000, plus the premium. Previous balance in the premium was $104,106. We reduced it by this entry here for the 6178. Sorry, this wasn't the premium balance. This was our amortized cost. The balance in the premium was most recently $141,106. Subtract out the amount by which we reduced it, 6178, and we get $134,928. This gives us a new amortized cost at the end of the year, $1,034,928. Okay, so we've answered parts A through E. F says, since January of 2024, the date that the bonds were purchased, market interest rates have fallen. And so your bonds now have a fair value of $1,050,000. Okay, so they have an amortized cost of $1,034,928, but we can sell them for $1,050,000. We're not going to sell them. We want to hold on to it and collect the interest. But if we did, we could get a gain. What do? Record the entry for the change in fair value. Well, we are not fooled by this. No entry needed. No entry, ignore changes in fair values, ignore fair values on held to maturity investments. We simply record the interest revenue, the cash we received, the discount, the amortization of any discount or premium. That's all we do until the end of the maturity when we collect our cash and we take off of the books the bond investment.